Traditionally, foreign exchange trading was the dominion of large banks, central banks, major corporations, and big institutions. In recent years, however, it's become much more popular and accessible to individual traders, and there's a number of reasons for this. First of all, it's a 24-hour market, which enables people to trade whenever they want and whenever it's convenient for them. In addition, through online trading, you can do it at home. You don't necessarily need access to the big trading platforms that were proprietary that people used in the past. You can get all the key information yourself from readily available sources such as internet sites and business newspapers. In addition, FX markets are extremely liquid, and because of that, trading spreads are narrow, and that keeps your costs low as well. Just like with other markets such as stocks and commodities, prices of currencies tend to depend on supply and demand. The more people that are interested in owning a currency, the price of it goes up. If people are less interested, the price of it goes down. There are a number of factors that can drive supply and demand for a currency, but generally speaking, people tend to prefer currencies with strong, stable economies, stable banking systems, and low political risk. So a number of the factors that can drive interest in a currency can include economic data. Certainly countries that are growing quickly tend to see their currencies in higher demand. Another area is risks. Countries with higher political risk tend to see lower demand and therefore see their currency prices go down. Interest rates are also a major factor when investing in a country. Countries with higher interest rates tend to be more popular than countries with lower interest rates. In the currency world, the bedrock and the foundation is really the US dollar. The US dollar is known as the world's reserve currency, which means that most of the central banks hold US dollars as one of their primary reserves. It's also a major currency in exchange. For example, a lot of commodities are traded based on US dollars around the world. Because of this, how the US dollar acts has a major influence on how other currencies act around the world. And because of this also, the Federal Reserve Board, or the U.S.'s central bank, and their decisions that they make can have wide-ranging ramifications. Also, when trading in currencies, most of the liquid pairs and what are known as the major pairs or the most active pairs involve the US dollar in some way, whether it's the US dollar versus the euro or the pound or other currencies. However, when two currencies are traded that do not involve the US dollar, for example, the euro versus the pound or the pound versus the yen, these are known as cross pairs. Some of them can be quite popular, but not quite as popular as some of the majors. It's important for new traders that are getting used to FX to understand that trading in currencies is a little bit different than trading in traditional asset classes. And the reason for this is that FX trading is based on what's called pairs trading. Pairs trading involves going long something and going short something, or being bullish on one thing and bearish on another. In traditional trading, people consider that I bought something, it went up, I made money, or I sold something, it went down. In the case of pairs trading, it's more that one can go up and one can go down, or they can both go up and down. It's a matter of how one does relative to the other. Now, pairs trading traditionally has been one of the core strategies of hedge funds, and what's called long-short trading has become very popular with many investors in recent years. Pairs trading is the foundation of FX trading because all currencies are traded in pairs. Everything is traded against each other. So, for example, you're trading the euro-US dollar. You may be long the euro and short the US dollar, or long the US dollar and short the euro. But in either case, it's how the two currencies fare relative against each other that's most important. What this means in pairs trading is that it's important to note you have to have an opinion on both currencies in the pair. You can't just say, I like the US dollar. Well, that's great. You may like the US dollar, but it may fare differently against the yen as opposed to the euro, as opposed to the Australian dollar or the Canadian dollar. Because of that, you need to have an opinion on both sides of the pair for this to work for you. Of all the currency pairs that are traded around the world, there are 4 that are particularly popular and active. Among these, the leader by far is the euro-US dollar. This is the most popular FX trading pair in the world, and what it basically trades off of is differing sentiment between the United States and Europe on any given day and also over the longer term. And this can be related to economic growth, but also in terms of the sovereign debt crisis has also had an impact on sentiment in trading. The British pound versus the US dollar, which is also known as cable, based on the transatlantic cables that they were originally traded across, is also extremely popular and has been long been a very well and active pair. There are two other pairs of note are the Japanese yen versus the US dollar and the Swiss franc versus the US dollar. Japan and Switzerland are considered to be fairly conservatively managed countries and very stable, and because of that they tend to act as safe havens for capital during times of crisis. Another major group of currency pairs are what we call the resource currencies, and these are currencies of countries that are large exporters of natural resources, and their economies tend to be influenced by changes in commodity prices. And different currencies tend to be influenced by different commodities. So for example, the US dollar versus the Canadian dollar is quite influenced by the price of oil in US terms, or the Texas price of oil, as well as metal prices. The US dollar versus the Norwegian krone, on the other hand, tends to be influenced more by the Brent or UK price of crude oil. Two also that trend to trade in tandem are the Australian dollar and the New Zealand dollar. These tend to be influenced by base metal prices as well as grain prices. And finally, there's the US dollar versus the South African rand, which tends to be influenced by changes in precious metal prices, as South Africa is traditionally known as being a major exporter of gold and platinum and silver. It's important when starting out in FX trading in particular to understand how pricing works in currency markets. When looking at a currency to trade or a currency pair, both pairs are in the currency and the order they appear in is particularly important. The first currency in the pair is known as the base currency. The second currency in the pair is known as the counter currency. When you look at an FX pair and rising and fall, it's in the value of the base currency. The best way to explain pricing in FX markets is to look at a couple of examples. So we'll start with the world's most popular FX trading pair, which is the euro versus the US dollar, euro-US dollar. In this case, what that means is it's how many US dollars does it take to buy 1 euro. So when euro-US dollar goes up, it means that it costs more American dollars to buy 1 euro. That means that the value of the euro has gone up, the value of the US dollar has gone down. On the other hand, when euro-US dollar goes down, it means that there's less US dollars needed to buy 1 euro. This means the value of the euro has gone down, the value of the US dollar has gone up. The US dollar is the base currency in almost every major pair that it is traded against. There are, however, 4 major exceptions where the US dollar is the counter currency. These are the euro versus the US dollar, the pound versus the US dollar, the Australian dollar versus the US dollar, and the New Zealand dollar versus the US dollar. So far, we've talked primarily about trading in paper currencies such as the US dollar or the Japanese yen. It's also important to remember that traditionally, other things have been used as currencies, most notably precious metals such as gold and silver. Gold and silver have acted as a store of value for millennia and have been treated as currencies, and to this day still play a role in currency markets. Gold and silver still tend to be seen as a store of value, and they tend to trade up and down relative to the valuation of paper money. So when paper money goes down in value, gold and silver tend to go up. On the other hand, gold and silver tend to go down when the value of paper money goes up. For the most part, gold and silver tend to trade opposite to the US dollar, with gold being the proxy for metal-based currencies and the US dollar being the leader of paper currencies. So it's understandable that they would trade opposite to each other. However, we've also seen in recent years that the gold versus the euro has also started to play an important role with capital moving in and out of Europe and in looking for safe havens. We hope to have provided an introduction to the exciting world of FX trading. We do have a number of other videos in this series that go more in depth in some of the other areas and things that affect trading in currencies, such as how economic news can affect valuations.